We are in the back half of the trading day now, and the tone has clearly shifted to risk off. Stocks are selling off into Friday afternoon, and the S&P 500 is suddenly at risk of finishing the week in the red. I'm Grant Mercer. This is Storm Stock Solutions, and we're here to bring some clarity through the chaos as we head toward the closing bell. What's changed since the last hour is the intensity of the pullback. Joy Wiltermuth at MarketWatch notes that Friday's slide has put the S&P 500 in danger of a weekly loss, raising the question, is this just end-of-week fatigue after a big run? Or is the market starting to smell something more fundamental? That question is landing right alongside some fresh Fed-related worries, and together they're taking some air out of risk assets. On the macro front, Jeffrey Bartash is highlighting a growing concern inside the Federal Reserve: the health of the jobs market. His piece asks outright whether the economy is losing more jobs under the surface than the headline data suggest, and points out that the Fed's recent rate cut may be less about victory over inflation and more about fear of a weaker labor market. That's a very different narrative than the soft landing nirvana we had priced in earlier this quarter, and it helps explain why traders are selling first and asking questions later this afternoon. Layered on top of that, you've got a fascinating sector divergence in healthcare and biotech. David Alderman writes that while the Fed cut rates, biotech essentially didn't notice. Instead of trading on macro headlines, many of these companies are focused on advancing the kind of smart science that might attract cash-rich pharmaceutical acquirers. For professionals, that's a reminder that some corners of the market are marching to their own drumbeat: deal potential, clinical data, and IP value, even as big indices react to the Fed and jobs. There's also a geopolitical and policy angle still simmering around semiconductors. Mihir Torsekos, MarketWatch. Opinion argues the US doesn't need more Nvidia-style chip deals with China. It needs to get tougher on tech imports overall. He floats the idea of a chip-for-chip tariff that could be both a national security tool and a revenue generator, while spurring more domestic semi-production. It's not policy yet, but it keeps the risk of trade friction and export controls very much alive for chip makers and their supply chains, right as investors are already on edge. In terms of areas showing relative strength or at least organized thinking, Philip Van Doren's work on stocks that could make sense into 2026 as the AI trade cools is still resonating. In a tape like this, the market tends to reward names with clear earnings, visibility, and balance sheet strength. Pieces that frame AI exposure through the lens of fundamentals rather than hype are giving traders a roadmap for where leadership might migrate once this bout of selling stabilizes. Let's talk sleepers and setups I'm watching in the background. First, that Broadcom story we flagged earlier in the day remains on my radar. Brittany Nguyen reported that investors are uneasy about Broadcom's lack of detail on a new AI customer and its relationship with OpenAI, even as analysts stay calm. In a choppier market, uncertainty around big-ticket AI contracts can exacerbate volatility in individual names, and it can spill over into sentiment on the broader AI hardware complex. Second, there's a consumer and regulatory undercurrent in streaming media. Alex Jacques is arguing that a sale of Warner Bros. Discovery to a giant like Netflix or Paramount could be bad news for customers, and that regulators should consider blocking deals or even breaking up big streaming to get prices down. That kind of commentary doesn't move stocks tick for tick, but it frames the antitrust risk that investors in big media and streamers have to keep in the back of their minds ahead of any future M&A chatter. And then, a bit more personal finance-oriented but still important for the bigger picture. Charles Passey's piece on what to do if you win a massive Powerball jackpot is really about managing any big windfall, thoughtful planning, pacing decisions, and not letting emotion drive the bus. Richard Eisenberg's writing on planning for a longer life, maybe living to 100, pushes in the same direction. Those themes feed into how households think about risk, savings, and asset allocation, which ultimately flows back into market demand for equities, bonds, and cash-like instruments. Into the next hour and right up to the close, I'll be watching three things: whether this sell-off accelerates or finds a floor, how rate-sensitive and cyclical sectors trade against these emerging jobs worries, and whether defensives like healthcare and selective biotech continue to decouple from macro noise. All of that will feed directly into our closing bell wrap, where we'll break down how this week really ended and what it sets up for next week. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.